it's clear that economic activity is slowing down. Many economists project a recession in the euro area, and all this in the backdrop of tightening monetary policy, high inflation, and an energy crisis. So the question is how this environment fits into the supervisory process for 2023.
2022 has been a very good year for European banks. I mean, the increase in interest rates has played a positive role on their profitability. The capital position is strong, and the asset quality has improved throughout the year, throughout the pandemic, and also in 2022 with a lot of disposals of non-performing loans or securitization of non-performing loans. So the starting situation is positive. Of course, as you said, there are risks ahead of us and a lot of uncertainties. The recession, which is estimated now to be shallow and short, might prove to be deeper and longer than we currently expect, or the interest rate increase might be faster, stronger, and longer in order to keep control of inflation. So banks need to be prudent, to look at all the possible scenarios and manage to, prepare themselves to deal also with these positive, possibly adverse developments. But in the baseline scenario, I think that European banks should still see, on average, their profits increasing and their capital position remaining solid. Of course, there could be distributional effects across banks, so there could be winners and losers, and that's why we're putting a lot of emphasis on the need to strengthen internal controls.
So the priorities, the supervisory priorities for 2023 will be then?
Well, we are focusing very much on making banks stronger and strengthening their controls, managing proactively credit risk, getting prepared to avoid a new, wave of non-performing loans, the need to proactively manage interest rate risk, and be careful with their exposure to those sectors which are particularly vulnerable to interest rate increases and to the energy shock, so energy-intensive sectors, for instance. And then we also have, while looking at the immediate challenges, we also need not to lose sight of the longer-term structural challenges for the banking sector, which are mainly the digital transformation and the climate change. In these two areas, we are focusing more and more of our supervisory efforts and resources.
Well, because you of course refer to credit risk, do you have a concern over a possible wave of new non-performing loans? Because it hasn't been the case during the pandemic. What is different this time around, if there is one?
Well, during the pandemic, of course, there was a huge amount of public support that was granted to households, to small and medium enterprises, to corporates, and these, of course, cushioned the banks from the potential negative impact of the sharp recession that we had. I don't expect that this amount of public support would be forthcoming in the same scale and undifferentiated, let's say, scope if we were to enter into a new recession right now, also because the budget of governments is becoming burdened by higher levels of debt. So I think that banks might face a more difficult situation, but honestly, let's say again, we need to focus the attention on the robustness of the internal controls and make sure that we have a prompt identification and management of any credit that starts deteriorating. That didn't happen last time, which meant that we had a pile-up of non-performing loans. This time we are more prepared, and I think that we can avoid it if banks are focused on the issue.
Well, Mr. Rendia, I'm sure that you've often heard this accusation for the SSM, in the meaning that US banks have always have more earnings and earnings growth, have better valuation, and this by many is associated with the stricter, let's say, supervisory requirements by SSM, which places European banks in a comparative, let's say, disadvantage over their US peers. How do you respond to that?
Well, we frequently meet with our colleagues in the US authorities, in the UK authorities, and we compare the requirements that we charge on our banks. And I must say that we are in the same ballpark as our peers. If anything, let's say the capital requirements for the largest European banks are a little bit lighter. So I don't think it is actually an issue of a regulatory burden, although, let's say, if there are criticisms, we are ready to listen to those criticisms. I think the issue is that profitability of European banks has been subdued for a long time. Cost efficiency has been not where it should be, and the low interest environment, negative interest environment, has been a drag on the profits of European banks for long. Now conditions are changing, banks are more focused, so I hope that I can fill the gap.
Well, okay, let's turn now to the Cyprus banking system, and on the onset I would like a comment over your collaboration with the central bank.
The collaboration with the Central Bank of Cyprus is excellent, I must say. We have very good cooperation in what we call the joint supervisory teams, that supervise individual banks, in the on-site teams, and also across the board, and also at the senior management level. So collaboration is very good, and I think that the fact that we have a unified voice in sending messages to the banks has been one of the key factors in having so much progress recently in the strengthening of Cypriot banks.
Well, thank you. I would like your view. Do you think that the Cypriot banks are, let's say, well placed to respond to this challenging environment?
Cypriot banks made a lot of progress recently, so yes, I think that they enter into this difficult phase, this uncertain phase, with a stronger position. Of course, there are differences across banks, but in general, the sector is much more resilient and robust than it was a few years ago. A lot has been done in terms of reducing non-performing loans. Notwithstanding, let's say, sometimes the legal environment is not so easy, especially I've noticed that on foreclosures there have been these suspensions of the framework, which has increased the uncertainty for banks on their possible recoveries on non-performing loans. But in general, a lot of progress has been made by the Cypriot banks, so they are well ahead in a normalization process that puts them in the same ship as in the same boat as the other European banks.
So because you mentioned on foreclosures, you are saying essentially that this continued, let's say, suspension of foreclosures creates a problem for the banks to recover bad debt.
Yeah, that's exactly the point. You need a stable and supportive environment to ensure that banks can manage their non-performing loans portfolios effectively and clean their balance sheet in a fast way when the crisis hits. If they don't do so, let's say there is an impact on the economy as a whole, because let's not forget that when you have a balance sheet which is clogged with non-performing loans, the lending capability of the bank is impaired. So the ability to support households, to support corporates, to support the recovery of the economy is much reduced.
On another issue, we have the Cypriot systemic banks now, which say they are well placed to capitalize on this tightening monetary policy. They say they have a strong liquidity held at the ECB, and now they will start getting paid over that liquidity as interest rates rises. And this, in combination with rising lending rates, will translate into an increased net interest margin. So they are upbeat over their projections for this year. And in the same context, the two banks now are preparing to return to dividend distribution following more than a decade since the previous crisis, and are engaging in dialogue with you. So, what is your view on that, as you will have the SSM, I mean, the final say on this, and what are the preconditions for the SSM to give the green light to this request?
Well, first of all, let me say it is indeed true that the increase in interest rates, the exit from the negative interest rate policy, has had a positive impact on the bank's profitability. That's a fact. And it will continue playing a positive role also for some time. But we should not forget that at a certain point also deposit rates will start increasing, and therefore the positive effect on margins will reduce accordingly. Anyway, the positive effect is there. The way in which we approach the discussions on distributions with Cypriot banks and any other bank under our supervision is that we have asked them to provide us their estimates on their capital trajectories under the baseline scenario, which, as I mentioned, is a shallow and short recession, but also under an adverse scenario, which would imply, let's say, a more negative outcome in terms of growth and in terms of interest rates. If the banks are able to prove us that they would be able to remain above our supervisory requirements, even in an adverse scenario, paying dividends, there would not be a negative feedback from our side. And that's the same for all the European banks.
And on another issue, we've had some developments recently concerning Greek Eurobank, which has increased significantly its stake in Hellenic Bank here in Cyprus. And Eurobank is poised to become the largest shareholder, of course, pending regulatory approvals. What is your view on that, in terms that the SSM has always supported cross-border mergers and acquisitions?
Well, first of all, let's say, we are not talking about a merger here. It's an increase in a stake, and there is a regulatory approval underway on which I cannot provide you with a final answer. And I don't like to speak, especially publicly, about individual banks, so you will forgive me if I cannot be detailed on this case. I will take your question as an opportunity to discuss more generally the issue of mergers. For me, mergers are an important tool that European banks can use because they are the most transformative opportunity on business models. So to make the business models more profitable, generate more capital, and put banks on a steadier course going forward, are a way to reconsider strategies, to reconsider digitalization, and to embrace the changes which are necessary at the moment. Cross-border mergers could be an important element on that. I mean, they are positive from a European perspective because they enable banks to diversify risks. I understand that in several jurisdictions that are still concerns which are a legacy of the past crisis, but now the difference is that we have the banking union. So we will have a fully integrated board that discusses possible cases, and we are the supervisor both of the parent and of the subsidiary. So we can see the pros and cons for all the parties in the group. So I think that this creates new conditions, and I think that within this framework, cross-border mergers could be a positive development.
Well, many say here in Cyprus that Cyprus is essentially overbanked. It has a lot of banks here, although we are a small place. Do you agree? Do you share this belief as a regulator?
To be honest, I think that Europe is overbanked. So overbanked maybe is not the word I would use. I think that there is some degree of excess capacity. We have seen a lot of increase in the size of the European banking sector in the run-up to the great financial crisis, and after there hasn't been a lot of exit from the market. In the US, for instance, you have had a lot of banks that have exited the market, you have had a lot of consolidation, and we haven't experienced the same process in the European Union. So I still think that there is some leeway to consolidate and reduce excess capacity in the European banking sector.